Okay. Hello, everybody. I'm Marina from Unicorn.Events, and today we're having a great guest. This is Patrick Flesner, a partner at LeadX Capital Partners. Hi, Patrick.
Hi, Marina. Thanks for having me today.
Thanks for finding time to join us today. How are you?
I'm fine, thanks. The weather is getting better. Sunshine outside. Awesome. Thanks a lot. What about you?
Yeah, we're having not bad also, like a little bit rainy today, but it's fine. And so we will have a couple of interesting questions, and I hope you will highlight some of your approaches to raising investments and to finding nice startups to invest. So what's your industry focus as a VC fund? Are you geographically agnostic or industry agnostic?
Mm-hmm. So our investment strategy is mainly based on 4 pillars. We invest in the consumer industries. We look for B2B tech companies. We invest in Western Europe, and we provide growth capital. So it's a little bit difficult to grasp, but I think it's important to understand we actually invest in B2B companies that provide digital solutions to B2C companies. And what is growth capital? For us, growth capital means we look for companies with at least 10 million in revenues, a 30% growth rate, and a viable business model. So we are not investors who look for top line growth only. We want to see really a profitable business or a clear path to profitability. That is probably an important differentiator. And also our focus is on Western Europe because we believe being close to the founders, being close to the management teams is really important, because if problems pop up, we want to be sitting next to the founders, next to the management team, solve these problems. Certainly our network is also the strongest in Europe, so we can help way better if we focus on Western European companies.
So as I see, you're taking quite an active role in the life of your startups, right?
Absolutely. We would consider us a very active investor. So it's not only about providing money. I think if as a vertically focused fund with a focus on one industry, our goal is to provide more than money. Our knowledge and our network is certainly very important. Also, the growth capital aspect is important. We actually, since we always invest in companies that have already found product market fit, product channel fit, we want to accelerate growth. So we know actually what companies need to do that want to expand internationally, want to broaden the product offering, want to find new channels to the customers. I think that is where we can be really a value-adding investor and board member. And this is also a reason why I recently, published this book, FastScaling, in which I actually explain how to get from initial traction to sustainable high growth. Is actually a reflection of our past investment experience, having seen so many companies that fail and succeed. I think this is what we bring to the table, the specific knowledge about how to grow businesses and how to get to really sustainable high growth.
Okay, sounds great. What's your average ticket size then?
So we look for companies where we can invest between 10 and 25 million over the lifetime of an investment. And the initial investment certainly depends on the company specifics. Maybe also worth mentioning is that we are not only looking for venture-backed companies where we invest in the Series C or Series D, whatever letter you will name. We will also be looking for bootstrap companies. So companies that have managed to get to 10 million in revenues without having received funding, where our capital can actually help them accelerate growth. So it's also, I think, a differentiator. It's not too common in this industry, but all the 3 partners, we all have worked in private equity and buyout and venture. And this is the reason why our portfolio will consist of half venture-backed companies and half bootstrap companies.
I see. Is it right to say that you're investing from Series B round?
Well, difficult to say. I mean, it's just a letter. I mean, some companies need to raise immense amounts of money early on, so they get to Series C, Series D without having found product market fit, product channel fit. So for us, it's actually only a letter and we don't care so much about it, whether it's a C or D or B. It's more about where is the company in the life cycle? Has it found product market fit? Is it ready to be scaled? Then it's the right time for us. And certainly, if the company has raised too much funding already it's sometimes difficult to find the right balance in terms of valuation, ticket size that we need, and certainly also it is about the attractiveness of the opportunity for us.
I'm wondering how old is LeadX Capital Partners, and did you manage to hunt any unicorns so far?
So we established LeadX in 2016, and the first fund generation has now is now through the investment phase. So we are now concentrating on follow-ons and value creation, and we'll start raising our second fund. We have not invested in a unicorn, and it's also maybe worth mentioning we are not looking for unicorns. So we are not a venture investor, a typical one, where you have one or two companies that return the whole fund and the rest might go bust. For us, it's more we are looking for stable businesses. So our goal is to get like to 10 to 12 investments where almost all succeed in terms of they continue growing, and we can make, let's say, 3x on the investments on average. For this, we don't have to be looking for unicorns. So I'm not a unicorn hunter.
Okay, I see. That sounds great anyway. 3x, it's already a very good result, and without any risks related to the companies, of the portfolio companies, this sounds really cool.
Yeah, it's risk-adjusted returns, right? Also for our investors. Mm-hmm. Yeah, the risk is probably lower because it's mature businesses, profitable businesses, or we see profitability in the home market and they become EBITDA negative because they accelerate growth, but the risk is lower certainly, and as we all know, lower risk means usually lower returns. Huh?
Yeah, but in your case, 3x, that's quite a good return even for high risk companies in the portfolio anyway. And I'm wondering if you see, how do you select the companies, or how do you source, let's say, startups or companies for your portfolio?
Mm-hmm. Very good question. I mean, we also pursue typical inbound, outbound approaches. Certainly, people know meanwhile that we are very knowledgeable about consumer industries and B2B tech. So we get some inbound opportunities. At the same time, I think what makes us special is, again, this vertical focus on this one specific industry, which enables us to really go deep into the segments of that industry, analyze specific segments. We conduct so-called sector studies where we identify trends, market developments, market dynamics, try to identify potential winners in this market, and then we will reach out to these kind of companies. This is, I think, the benefit of having a vertical focused fund. And then certainly we also go to events and participate in unicorn events.
Oh, thank you so much. And yes, we're very thankful to you that you very often find the time to join us in our battles and events. And so far, you saw a lot of startups pitching. What's the most important for you when a startup is pitching? What's your focus? What's the most important criteria to see if the startup is interesting or not for you?
Yeah, I mean, there are many important aspects. Certainly, it starts with the people. Are they convincing? Do I believe that they can pull it off? I mean, it's one challenge to get from 0 to 1 to initial traction, but it's totally different challenge to really create sustainable high growth businesses. And also, experience has proven that only because some founders made it to 5 million, 7 million revenues doesn't mean that they can create a 100 million revenue business. So for us, it's really important to understand the senior management team. Is it a complementary team? Is it coachable? I think this is really important for me. I usually, also my book talk about leadership styles, self-awareness. Do they understand where the weaknesses are? Can we help them overcome the obstacles as an investor? Are they self-regulated? So I think I personally do not like to work with people who shout at others. It's like, for me, this is not required in order to lead a company, but maybe personal style. So leadership style is important for me to understand dynamics in the team. And then certainly market. Usually founders, unfortunately, overestimate the market size. I believe so. We are very diligent about analyzing how huge the market actually is. And I'm not talking about total addressable market, but really serviceable addressable market and serviceable obtainable market for the company. That's important. And then as a growth capital investor, I think what some founders don't get, if you pitch an early stage investor, it's usually about market size, market opportunity, and team. Mm-hmm. For us, we invest in companies that are there already for 5 or 6 years. So there's a lot of data that we want to see. We want to see strong unit economics, so that the business model works. We want to see how the company has performed in the past, be it a conversion from lead to a customer. What is the customer satisfaction looking like? So really analyzing the past data and trying to understand what does this actually mean for the future, and are the founders also realistic about the future? So I'm not looking for this kind of exponential growth business plans where people tell me, well, this is what VCs want to see. I would like to see a really realistic business plan where I understand what the assumptions are and why they derive at the revenue and EBITDA numbers.
Thanks, Patrick. And how long does it take normally to the whole due diligence process regarding your experience?
Mm-hmm. And depends on when you where you start naming it a due diligence process. Mm-hmm. I personally like being in touch with founders early on, so even way earlier, so too early for us to invest, because I really want to understand how the founders in the company develops over time until they get to a point where they are ready for my investment. So I would call it already the first touch point being the start of due diligence, but I guess that's not what you are referring to. It's more about, okay, it seems like an attractive opportunity. Let's do something together. How long does it take? I would say, again, depends. Typical process would be, I would say, 3 months. But it can be longer. It's rarely shorter. Certainly, everybody always says, let's be quick, be fast, and there are good reasons for being fast. At the same time, we have also a duty vis-a-vis our investors. So we need to be diligent. We have to do our due diligence. Need to be thorough. And for us, it's also important to use the due diligence phase to understand where are the challenges. What do we need to do to overcome them? So we always create kind of 180 days plan in which we discuss with management teams what we need to do in order to actually achieve the growth targets that we set ourselves. So I think it takes some time, but it's hopefully worth it.
Sounds great, and I liked your approach when you're kind of observing the startup for a long time before you make the deal. So you can see the growth potential and how they are developing and how fast are they reaching their goals, and are they reaching their goals? So that's perfect. And any other advices and any other piece of advice you can give to our startups to be more successful in raising investments from your point of view?
Yeah, of course, but let me again touch upon this period of interaction. I think for me, it's still a people's business. I mean, if I invest in a company, I have to work with the founder for 5 years, 6 years. So it's really important that the chemistry is okay, not only for me, but also for the founder. Yeah, so
like a perfect match. It should be a perfect match, right?
Exactly, yeah, because I think there will be challenges ahead, and I think it's important to create a trustful relationship, and it's also fun working together. So surrounding yourself with people that are knowledgeable and that you like from a personal perspective is, I would say, one important advice that I have. It's way more important than 1 or 2 million more in pre-money valuation. So I would always look rather for the good fit investor than the highest valuation, because if you raise money on a valuation that is probably very, very high and attractive from a short-term perspective, these kind of high valuations can haunt founders in the long run when they need to get the next investor to invest. And the next investor says, well, now I would invest on the valuation the previous investor invested on. So I think finding a fair valuation, a valuation that is fair for founders, current shareholders, and new shareholders is also another advice I would have. And then the pitch deck should be really customized to the key investors that you are targeting. So find the one that invests in your stage, in your industry, that is knowledgeable about it, I think, and do not waste time pitching to VCs or investors who will not invest in anyway, because it's not your or their turf. I think this is also something that I would share as a guiding star. Yeah, and then be ambitious, but also be realistic. As I said before, I mean, it's good to pitch, but I think I see sometimes founders inflating numbers, and that makes me a little bit nervous because yeah,
it doesn't build the trust. That kind of behavior ruins the trust, right?
Absolutely, absolutely. So if I see very often I see founders who calculate unit economics not in the state of the art manner. Yeah, so there are two reasons for this. Either they want to show me better numbers, so numbers that are better than they actually are.
They want to look more attractive, yeah.
Yeah, maybe this, or they don't know how to calculate unit economics. Either way, it's not good. Yeah, so that's, for example, sometimes I see, and if you see that people don't calculate unit economics or inflate unit economics, you ask yourself, what else do they inflate? Yeah, so
exactly.
I think ambitious and realistic, I think, is a very good combination.
So it's like, in general, you can advise to a startup, like, be yourself. If you're cool, just be yourself.
Yeah, absolutely. I mean, sometimes it's difficult for founders. No? They struggle and it's not working as they wanted it to work. So they are certainly inclined to show a better business than it actually is. So it's not easy to be a founder, and I'm really admire people who have embarked on this kind of journey. I've never been proud and brave enough to do so. So it's difficult, it's hard. Yeah, but I think being honest, being transparent, probably in my view is the best approach. Huh?
I hope so, because I heard different approaches, like especially in Silicon Valley, like fake it until you make it, and so on and so forth. But I personally agree with you that it's maybe to build the trust is the most important, especially on the stages when you step in. So it's like already a company, like a well-developed company. So it's not even a startup. I mean, in the general meaning of that, yeah. Yeah. So thank you so much, Patrick, for finding time to join us today. And if you want to say some words, like in the end, or something for our audience or startups or organizers, whatever, just the floor is yours.
Yeah, thanks a lot. Yeah, so again, I mean, for all the founders and management teams, if you are a B2B tech company selling to B2C companies with at least 10 million revenues and 30% CAGR, and headquartered in Western Europe, please reach out to me. You will find me on LinkedIn and Twitter. Happy to connect. Also, if you wonder how to actually grow a business, buy my book, FastScaling. Yeah, it's supposed to help you guys get from initial traction to sustainable high growth. Feedback has been great so far, so it must be something in there that helps founders succeed. So I hope it helps you as well.
Thank you so much.
See you on the next Unicorn event.
Yeah, and see you at the next Unicorn events, exactly. And a very nice book of yours I'm recommending myself. So for reading, and thank you again for joining us today.
Was fun. Thanks for having me, Marina.
Bye.
Bye.